Welcome back, everyone, for another episode of the Microfamily Millionaire. And this is a sub-series to the Share the Wealth show where I discuss strategies on small multifamily investing, what I'm doing, what's going on in the industry, just some insights and anything else for people who want to get started in multifamily and don't know where to start. We have not been here in a while for the Microfamily sub-series. And if you have listened to the Share the Wealth show, episode 100, I go into a ton of detail about what was going on with me this year personally, just to give you some insight and how you just keep pushing forward, right? So right now, what I'm going to do is this is our relaunch of the Microfamily Millionaire, and I'm getting started with being consistent. I figure I am in a much better space now, and it's time for me to get this thing restarted so that I can bring you guys value and help you on your journeys. So, if you want to get into multifamily, it's probably for cash flow, right? Yeah, you want to quit your job and be job optional. You want the freedom to travel more. You want more options in life. You want to create generational wealth, have a legacy, help your community, et cetera, all the reasons. But all of that boils down to the cash flow. And without it, you can't do any of those other items. Cash flow comes first. You need the financial freedom and the flexibility as your first pillar to be fulfilled that will allow you to experience any of the other freedoms in life. If you want time freedom, location freedom, just like flexibility and options, you need that cash flow first if you don't already have it, right? Or you need to replace your W-2 cash flow. And that's why most people want to get into multifamily. Most people also, or you maybe have probably heard this, that all the gurus on stage are saying go big or go home because it takes just as much work to do a large multifamily as it does to do a small deal. So you might as well just go big. So, okay, great. Now you're sitting in the conference or whatever it is, and you decided to go buy one large multifamily building, at least give you a few thousand extra dollars per month. And let's say you're starting off realistic and you don't want to go with a 100 unit, but you're going to go with at least 50, right? This will be your one and done kind of thing. Not that you're going to stop at the 50 unit, but with this one, you're going to be able to do a good amount of cash flow. You can be financially free with this one, and everything else will be like cherry on top, right? And maybe you'll get like $5,000, $10,000 a month in monthly cash flow. So you start searching for the 50 unit and you find one in a relatively inexpensive Midwestern market that costs $75,000 per unit. Let's just throw out that random number. But that is super low, or at least that's what you heard, right? But with 50 units, that's $3,750,000 with a 30% down payment, which is what's required by most local and regional banks, right? You're going to need $1,125,000. That's not including like your CapEx costs or your rehab budget or other additional funds that you need to implement your business plan and your repositioning strategy. So at $75,000 a door, is highly unlikely that this building is turnkey and it probably needs some improvements. So, okay, all right, no problem. You'll raise the $1 million plus dollars needed and you'll just do a syndication, right? Cool. Normally, the minimum in a syndication is about $50,000. You could do 25 if you want to make the opportunity available for more people, right? And a lot of people in your circle don't have $50,000 to invest. They probably don't really have $25,000 to invest either. But honestly, let's just go with it, right? So you're going to raise capital. If you are doing a $25,000 minimum, then you need 45 people. If you're doing a $50,000 minimum, then you need 23 people or investors. That's why sometimes some syndicators require a $100,000 minimum because then you need even less investors to help you fulfill that, right? But this is your first apartment building. This is your first syndication. Do you know 23 to 45 investors who trust you enough and who will invest $25,000 to $50,000 each on your very first deal when you have no track record? will your offer actually even be accepted by the broker or the seller? Because there's no guarantee that you can close because you haven't done this before, right? You don't know all the ins and outs of the acquisition process. So, as you're going through this process and you're trying to get this deal closed, you realize it's a little bit harder than you thought to get the capital together. Um, you think, okay, no problem. I'll just partner with an investor or team who's experienced and has a track record, which is smart. It's actually very smart to leverage the experience of someone else in your effort to raise capital and to get a deal done. Super smart. So, in this type of deal, in any kind of syndication, your percent ownership of the deal depends on how much you do or are responsible for and how much value you add to the general partner team. So if you are new and you're joining in with an experienced team to leverage their experience, then you're probably not really adding enough value to warrant a large cut of the ownership. Syndications are split into buckets based on what you do and the value add and what you're actually bringing to the deal and the sweat equity that you're putting in, right? Common buckets of responsibilities for the splits among the general partners of the deal are due diligence costs. So these are it's non-refundable money that you have to put up just to vet the deal, just to do like inspections and things like that. Then there's acquisition management. That's finding the deal, underwriting it, securing the debt, having the winning bid, like coming up with the business plan, all of that stuff. Being a sponsor is someone who has a high net worth and bank account balance that supports the loan amount, because in commercial real estate, when a banker is looking at a deal, they want somebody who has a net worth equal to the loan amount and liquid bank account balance of that amount. So normally someone will come in and maybe get, sometimes that's a business model. Some high net worth individuals sponsor deals and they get like 2%, 3% of the deal just for putting up their balance sheet, right? Then there's also investor relations. So these are the people who are the investors who are raising funds and managing all communications with the limited partners, things like that. Then there's asset management. This is actually executing the business plan that was decided on when you were doing the due diligence, right? This is managing the property managers. This is just making sure the deal is operating at the level that it's supposed to so that it increases value. So only general partners who get on the asset management team get any cash flow from the deal. Okay, so now that is the splits for the responsibilities. Now let's talk about splits for the finances, right? So depending on how many general partners there are and how much responsibility like you can handle, that's going to depend on how much your portion ownership of the deal is. So let's just imagine, let's say there's 5 general partners on the deal, right? That's pretty standard. So if we split that evenly, even though that's not common, but if we split it evenly, that means of the general partnership between 5 members, every general partner will get 20% of the general partnership, right? So 20%, 5, that's 100% of the general partnership. But if the general partnership is only 30% of the entire deal, then what is your percentage of the entire deal? You might have 20% of the general partnership, but of the deal is really only about 6%, right? So let's think about this. General partnership is 30% of the entire deal. You have 5 general partners. 6% times 5 is the 30%, right? So you really only get 6% of the entire deal. And this is imagining that we're splitting it equally, right? So that's not normal to split it equally since it's about what you're actually contributing to the deal. So let's say realistically, as a new multifamily investor doing your very first syndication, let's say you get like 10% of the general partnership, which is actually pretty generous. Your net ownership of the entire deal is only 3%, right? Now let's break this down and what some numbers really look like. Let's say an acquisition fee is about 3% of the deal. which is normal, right? So let's say you had to raise, remember we were talking before about, I think you had to raise 1.25 on this example, but let's round it up to 1.5, and it's probably not enough, but we'll just round up to 1.5 to deal with whatever repairs and maintenance and CapEx is needed at the beginning, right? So 3% of 1.5 million is $45,000, right? But that's 3% for the whole general partnership team. So if you have 3% of the entire deal, right? 3% of $45,000 is $1,350. So that's the fee that you would get at the very beginning. We'll just round it to 1,500, right? So any other cash flow you're going to get from this deal is only if you are part of the asset management bucket for the responsibilities, right? Asset management is really only like 2 to 3% of the deal per month anyway, right? So let's say even if the deal cash flows $20,000 per month, the asset management fee at 3% is about $600 per month. And that's to be split with whoever is on the asset management team. If you're not on the asset management team, you're not getting any of that, right? I don't know what your expenses are per month, but I'm guessing they're probably more than $600 if you were 100% of the asset management team. So let's say now the deal sells at a 2 equity multiple, which means equity multiple is just how much equity a private investor, passive investor came in with, and you double that. So 2 equity multiple, you double you times it by 2, right? Which 2 is a standard like um goal for a lot of syndicated deals is to reach that 2. Normally it gets like to 1.7, 1.5, 1.8, something like that will be good. So you're in that 2 range, right? Let's say, so you raised 1.5 million for the equity. And so that means if they're getting a 2 equity multiple, that means all the passive investors will get $3 million in profit at the end. And let's just say it really should be a little bit more for them to have a straight 2, but we're just going to go with this for easy numbers. So 30% of this is the general partnership team we're talking about now. If the general partnership team gets 30% of this profit at the end, then that's $900,000, right? But your 3% of that $900,000 is $27,000 because remember you own 3% of the entire deal, right? So at $27,000, that's still something that it takes 5 to 7 years to realize the business plan on a large multifamily property, right? Unless the market is super hot, like it was a couple of years ago, people were reaching their equity multiples and their projections way faster. But now, in this new economic climate that's coming up, it's not going to be as easy or as quick to hit your numbers. So let's say, so you get $27,000 at the end of 5 to 7 years. You got 1,350, let's say 1,500 rounded up at the very beginning. You're getting either nothing on the cash flow or maybe a couple $100, depending on what you're doing with asset management. So are you really quitting off of one deal? Do you really have financial freedom that you're thinking about? Do you really have that $5,000 to $10,000 a month that you think a 50-unit deal should be giving you? Not really if you are going to need to syndicate the deal, right? So the whole point of this is just to make these numbers realistic. And for you to go in with your eyes wide open and know what you're getting into, be aware of what to expect, have reasonable expectations for what the cash flow or the payouts are going to be and the time frame of these payouts, right? So you don't walk into doing all this work for this big deal, assuming that this is going to be your one and done or your make and break, or this is going to really set the road for your financial freedom. It can. Like, there's no wrong way to do multifamily, whether you want to do smaller buildings or you want to do big syndications. It's all fine. Like, it will all get you there. It all takes a lot of work and it all takes a long time, right? You just have to know what your resources are and figure out what strategy works best for you and for what you want to do, right? Don't put all your eggs in that one basket thinking that this is going to be that financial freedom for you with this deal. And just be ready to pivot if it's not really what you expect, right? Any wealth building journey, any multifamily or otherwise, is going to take time and effort, but just pick your journey wisely. And you definitely can get into syndications and layer them and make sure maybe you join in with a couple of different syndication teams, or you're with a team that is super busy and does 2 to 3 deals a year, right? But when the market is a little bit slower, some experienced operators, they are extremely even more picky on what kind of deals they close. And so they don't do a deal in a particular year. They're just focusing on making sure asset management is right and that the deals that they have are going to be profitable. So there could be years where it's lean and you don't have, multiple deals in the pipeline, right? To give you that cash flow. And then how much capital are you really raising for each one of these deals if you have multiple deals in the pipeline? Maybe it's harder than you thought to raise the capital, and maybe you struggle to raise some for the first property, right? So what's your other skill set that you are going to develop over this time frame to put you into the other buckets to help with the deal if you are not a strong capital raiser? So you have to decide what your transferable skills are from whatever else you're doing or whatever other experiences you have that you can still add value to the team and get a reasonable cut of the general partnership and of the deal. If you're watching us on YouTube, then leave a comment and let me know, was this information clear and helpful for you? Are there any other questions that you have? If you're listening to us on Apple Podcasts, then also leave a review. This helps this message get out to more people so that we can help dispel any misconceptions that are out there. And people are wasting tons of money on mentorship to figure out at the end that doing syndication is not really what they wanted to do, or it's not what they thought. Right. And I've talked to so many people who've spent $30,000 or $40,000 on a mentorship program that teaches syndication and teaches this go big or go home model. And it's not giving them the cash flow that they expected. It's not giving them the financial freedom. So in any case, leave us a review so that we can reach more people with this message and just give them some clarity so that they're making decisions, and so that you are also making decisions that are based on the real numbers behind the curtain, right? That's what I really am passionate about doing, is just being as transparent as possible. So in any case, I will see you on the next Microfamily Millionaires episode.